This stock is being ignored right now. And I mean completely ignored. No one is talking about it on Twitter. No big analyst is covering it. You won't see it trending on any stock forum. It is completely flying under the radar. But here is the thing. While everyone is chasing the same 5 overvalued names, this little company has been quietly doing something extraordinary. Think about it like this. Think love, think health, think global reach. Still not getting it? Good, because that is exactly the point. The market has not connected the dots yet. And when it does, and it will, the people who were early are going to be the ones celebrating. So stay with me till the very end, because the insight I am going to share in the middle of this video, that is the part most people completely miss. That is what separates a good trade from a great one. Let us get into it. So what is actually happening here? First, this is a small cap sleeper, and I use that word very deliberately. Most retail investors have never heard of this company. There are no celebrity endorsements, no fancy marketing campaigns, no influencer deals. Nothing. It just quietly operates, delivers results, and goes back to work. That is actually point number 1 in its favor. Because when a company this small produces numbers this big, and the market has not noticed yet, that is your window. That is the early entry most investors dream about, but rarely find. Second, the financials are exploding, and I do not use that word lightly. Every single metric, sales, profit, earnings per share, has jumped triple digits year over year. Not one metric, not 2, all of them, at the same time. That is not normal. That is not a coincidence. That is something structural happening inside this business. Third, there is a global demand tailwind that most people completely underestimate. This company operates in a sector where the biggest buyers are not you and me at a shop. The biggest buyers are governments, United Nations bodies, international health organizations, and they are buying in bulk. That changes the entire nature of the revenue story. This is not hope revenue. This is not speculative demand. This is contracted, institutional, large-ticket demand, and it is growing. One company. 3 reasons it should already be on your watch list. Okay, so now you know what is happening, but why should you actually care? Let me give you 4 reasons. Number 1, the total addressable market is massive. We are talking about India's healthcare and wellness space, which is a 7,000 crore plus opportunity and still growing. And here is the key part. Institutional bulk buyers create a guaranteed revenue floor. So even in bad years, you have a baseline. That is rare. That is valuable. Number 2, government contracts. Think national health programs. Think United Nations procurement. Think ministry-level tenders. When a company wins those contracts, it does not just get revenue. It gets revenue visibility. It gets predictability. Most companies in this space are praying for consumer demand to show up. This company already has confirmed orders sitting on its books. That is the difference. Number 3, margin expansion. This is the one that really gets me excited. Revenue doubled, but profit tripled. Read that again. Revenue doubled, profit tripled. That is called operating leverage. Every extra rupee of sales is dropping more and more to the bottom line. The business is getting more efficient as it scales. That is the hallmark of a genuinely high-quality business. Number 4, export engine. This is not just a domestic India story. There are significant export revenues coming in from high-income geographies, and those revenues are priced in foreign currency. So you get the rupee depreciation benefit on top of the volume growth. That is a double tailwind most people are not even factoring in. Now, this is the most important part of this entire video. This is what the market is missing. Nobody, and I mean nobody, is pricing in the institutional demand. The street is modeling this company like a consumer brand, like it is selling products off a shelf. Like demand is going to fluctuate based on consumer sentiment and advertising spend and all of that. But that is completely wrong. This is not a consumer brand. This is a procurement machine. Government tenders, bulk orders, long-term contracts, repeat business from the same institutional buyers year after year. When you model it correctly, when you look at it through that lens, the valuation gap becomes very obvious very quickly. And here is the mispricing opportunity. The P/E ratio is still in single digits for a company that just posted 214% net profit growth. Single digits. Let that sink in. The market has not caught up. The price has not moved to where the fundamentals say it should be. That is the gap. And that gap is the opportunity. And then there is the quality of earnings. These are not accounting profits. These are not paper gains. This is cash-backed, real revenue from confirmed repeat government orders. High earnings visibility, consistent cash flow, low risk of a nasty surprise quarter end. That combination, growth plus quality plus mispricing, is extraordinarily rare. When all three of those things exist at the same time, that is when the smart money moves. All right, let us talk numbers. And I am going to keep this simple because the numbers here do not need any dressing up. They speak entirely for themselves. Sales, up 116% year over year. Revenue went from 61 crore to 132 crore. That is more than double in 1 year. EBITDA, up 174%. Operating profit went from 18 crore to nearly 50 crore. That is a big jump. That is the margin expansion story playing out in real time. Net profit, up 214%. Bottom line went from 11.6 crore to 36.3 crore. More than tripled in 1 year. That is unusual. That is the kind of number that usually makes an analyst sit up and start paying attention. And EPS, earnings per share, went from 9 paise to 27 paise. 3 times. So not only is the company making more money in absolute terms, the per share earnings have tripled. That is what matters to you as an investor. Now look at the bar chart. March 2025, 61 crore. December 2025, 104 crore. March 2026, 132 crore. This is not a one-time blip. This is not a single good quarter followed by a reversal. 3 consecutive quarters of acceleration. The trajectory is up and to the right every single time. That is the growth curve, and the market is still asleep on it. So what is going to wake the market up? What is the trigger? There are 4 things I am watching. Trigger 1, a large order announcement. If this company announces a new government contract or a fresh UN procurement deal, that is an instant re-rating event. The stock does not wait for the next quarter results. It moves on the announcement. So watch the exchange filings. Watch the press releases. When that news drops, the window closes fast. Trigger 2, capacity expansion news. If the management announces new manufacturing lines or a plant expansion, that is a massive signal. It means they are not just enjoying a cyclical spike. It means they are confident enough in future demand to commit serious capital. That kind of conviction from management is always worth paying attention to. Trigger 3, Q2 FY27 results. If the next quarter sustains or beats this growth rate, institutional money will have no choice but to take notice. Fund managers cannot keep ignoring a company that is compounding at this pace. One more strong quarter, and this moves from a retail discovery to an institutional conviction buy. Trigger 4, index inclusion or analyst coverage. Right now, this stock has 0 analyst coverage. 0. One initiating buy call from a mid-cap research desk could mean a 15 to 30% re-rating overnight. Not because the fundamentals changed, but because the spotlight finally found it. Any one of these 4 triggers is enough to move the stock significantly, and all 4 are possible in the next 6 to 9 months. Now, I am going to be honest with you, because I think that matters more than hype. There is one real risk here, and it is a meaningful one. Concentration risk. A significant portion of this company's revenue comes from government and institutional tenders. That is a strength until it is not. If any major contract is not renewed, if a competitor comes in and underbids, if government procurement priorities shift, revenue could drop sharply in a single quarter. not gradually, sharply, in one quarter. This is not a consumer staple with predictable shelf pull demand. A regular consumer company, you can estimate demand by looking at store footfalls, retail data, ad spends. Here, one contract renewal decision can swing the quarterly number by 30 to 40%. That is the risk you are taking on. So please do not size this position like it is a large cap, low volatility compounder. It is not. It is a high growth, moderate risk, small cap story. Position accordingly. But here is the flip side, and this is important. The same concentration that creates risk also creates opportunity. Concentrated institutional demand means price discovery is slower. The market takes longer to figure out what the company is worth. And when that re-rating finally happens, when the market does catch up, it does not happen gradually. It happens fast, very fast. That asymmetry, slow to be discovered, fast to be re-rated, is exactly what creates alpha. So let us bring it all together. Sales up 116%. Profit up 214%. Earnings per share tripled. 3 consecutive quarters of acceleration. Institutional demand nobody is pricing in. A mispricing gap that is hiding in plain sight. A company with triple-digit growth, institutional moats, and a market that has not priced it in yet. That is the story. That is why I think this name deserves a spot on your watch list at the very least. Now, am I telling you to go buy this right now? No. I am not a financial advisor. This is not financial advice. Do your own research, understand the risk, size your position appropriately. But am I telling you that this is one of the most interesting small cap setups I have come across in a while? Absolutely yes. The numbers do not lie. The trajectory is clear. The trigger is coming. The question is just, will you be early or will you be watching from the sidelines when it moves? That is all from me. If you found this useful, smash that like button. Subscribe if you aren't already. And drop the company name in the comments. Let me know if you figured it out. I want to see who was paying attention. See you in the next one.